This conference will now be recorded.
Hi, I'm with Surety. Nice to meet you.
Vicky's our start.
Okay. Did you get the one?
Yeah.
Added?
Yeah. Are we recording this? Oh, sure.
You have to press back.
You just press the key.
Yeah.
Okay.
Good morning. We're going to go ahead and get the introduction started so that we can be sensitive to everybody's schedule. We very much appreciate everybody's attendance today. This is our sort of first version 1.1 of Sterling Seacrest University. It's been a while since we've put a program on due to the sort of the craziness from COVID. So we're real pleased to get back on track with this program. My name is Doug Reeder, and for those who don't know, I'm the chairman and one of the founding partners here at Sterling Seacrest. If you don't know us, we're a multidiscipline commercial insurance agency with deep industry verticals in healthcare, construction, real estate and hospitality, transportation, logistics, nonprofits, and private client risks. We also have a large benefits consulting practice, which is industry agnostic. We've got approximately 200 associates across a half dozen offices in the Southeast. We appreciate you joining for our program today. As part of our Sterling Seacrest University program, we attempt to curate programs that deliver topical, relevant, and actionable business intelligence that you can use back in your companies. As such, we cover a variety of topics and deliberately try not to be too insurancy, if that's a word. This program kind of came out of some conversations that we've had throughout the summer. We do a lot of surety business with Travelers and a number of other sureties. And as we've gone through the summer and the lockdown and the whole 9 yards, we've batted back and forth the economic impact that's coming our way in construction and insurance. Our business, the impact of slowing economy tends to lag what's happening out there. And so this COVID-19 situation has turned all of our worlds upside down, and we're all adjusting to it and adapting in real time. The impact on the economy is significant and likely to be long lasting. As such, we and the folks at Travelers felt that a program centered on managing in the new normal would be very topical and pertinent to our clients and friends of the firm. As a leading writer of surety and construction insurance across the country, Travelers has a unique perspective into the challenges that construction companies face and a pipeline into a large amount of performance data which informs their perspective. Today, we have two of the leaders from the Travelers Bond and Financial Products team in the Atlanta office. And they're going to attempt to show us how to manage for the new normal using tools for things like stress testing, how to they're going to speak to right sizing your business to the economic demand that is coming, and then planning for the coming economic conditions. Brian Nichols began his career with Travelers Construction Services in Tampa in January of 08. In November of 2017, he came to the Georgia office to become the managing director for the Travelers Construction Services Group. He's responsible for Travelers construction operation throughout Georgia. In his role, Brian oversees a team of 4 underwriters and a surety book made up of contractors of various sizes and trades. And for those who don't know, Travelers is the leading market share, #1 market share surety in the industry. Ryan Otwell is a native of Sandy Springs. He earned his BBA in business management from UGA and his MBA in finance from Georgia State. He also holds a CPCU and an AFSB designation, which is a surety designation, the second one. Ryan is an account executive officer for Travelers Bond in Alpharetta and has been with the company for 17 years. He's currently the president of the Surety Association of Georgia. Both guys are very experienced and have a lot of client depth to draw upon. So we're really excited to have him here to do this program for us. Welcome, Brian and Ryan.
Thanks, Doug. Appreciate you having us out. Appreciate Sterling. So as Doug mentioned, we're kind of topic today is managing the new normal. We'll try to give our best to, we're going to have to look back, a little bit in order to look forward, give you some information we've compiled, some information we found, some leading indicators, and a few resources. So I think the chat feature is open. If you're online, feel free to ask anybody here. Raise your hand. We'll do our best to answer any questions. So. Here's our mission statement, and we're in the business of helping contractors succeed. And this is one we've adopted many, many years ago. And it really, truly is our mission more now than ever. Our thought is if we can help a contractor be successful, they're a long-term client for us. And then a long-term, partner for the future and economic impact. So. Oh, there you go. So again, where we were, we'll talk about a little bit about COVID and then kind of some forward-looking indicators and then how to prepare for that. So kind of give you a backdrop. Back after the Great Recession, this was a slide we used to show our customers, and we called it the marginalist recovery. Essentially what we were trying to show them was we've come back from the depths of 2010. Revenues, far outpaced where it was. But margins just really weren't getting where they need to be. So the blue line's revenue, red line's margins, and everybody kind of had their head down. They were still used to slugging it out from the Great Recession and really just trying to get what they could get. And the purpose was margins should probably be going up since revenue was going up, and trying to get people to go back and get some more margin. I said, why talk about that? That was obviously many, many years ago. Well, the problem that you'll see is we never really did get margins back. So if we are anticipating some sort of slowdown, the revenue side is expected, but we may be slowing down from a margin standpoint way more than what it was because we never really did get it back up there. So we tried to use our data and analytics to give that message out there, and some did it, and some there was just market conditions that couldn't get there. But that was kind of our message kind of heading into this next kind of recession, I'll say.
So we thought this quote from Mike Tyson was a pretty good segue into the COVID environment. And COVID was certainly the punch in the face that all businesses and individuals felt and didn't expect. So here we are trying to reassess where we're at and plan accordingly. I think this quote's also a good reminder that there's always going to be something out there, something unexpected that happens in the world that we don't have control on is going to have an impact to our business. So planning your business accordingly to be able to get through trouble spots is very important for long-term success. This slide demonstrates the impact to the U.S. economy by GDP so far from COVID. The data goes back, looking over to the left, to the late 1800s. And what you see here is the thin blue lines are the percentage change in GDP quarter over quarter. And the tan lines, I know you can't see it as well here in the room, are recessions. And if you look down to the line on the far right, that is NBER's estimate of decline in GDP between the Q1 of 2020 and Q2. So that's an advanced estimate. It could change a bit over the next couple months. It's probably going to be in the ballpark. NBR is National Bureau of Economic Research, I believe. We're fortunate in Georgia that we haven't experienced a GDP drop like that. And there's several reasons for that. We have a pretty strong and diverse economy. We have pro-business policies that continue to retain talent, retain businesses, and also draw in new companies and talent, even through the COVID environment. And we also happen to have a policy on COVID that is favorable to businesses as well. The big question for Georgia is, what is going to be the duration of this recession? What are the long-term impacts?
So the big question most of our contractors have asked us is, have we weathered the storm, or is this the calm before the storm? And in most cases, it's probably both. I think we've weathered the COVID storm from a construction industry standpoint. It would prove we were resilient in getting out and protecting our job sites, putting in safety policies and showing that it is essential business that can operate safely in the kind of the environment. In Georgia specifically, we really didn't see the hardcore lockdowns and shutdowns that we saw on job sites in the Northeast and out West, and really we're kind of able to function for the most part. I think though we're also on the calm before the storm just from a market impact, and there is going to be some economic impact. I think we'd be foolish to think there wouldn't be in certain sectors, especially anything related to hospitality. And technically we entered a recession in February if you look at a lot of data. So there are some still steps to take to prepare. So COVID's kind of come and gone, although we're still living with it. I think job sites and stuff will function, but what will be, any sort of revenue drivers or market or margin drivers in the future is kind of that calm before the storm. So in order to kind of prepare, you got to look at some indicators. And I personally think one of the best leading indicators is the Architectural Billings Index. This is done by architects, so everybody knows the construction process. It's got to go through architects and engineers before it comes out to a job site and be built. And so they measure their activity on a month-over-month basis. And in March and April, we had the largest single drop in history since they've been measuring the Architectural Billing Index. A number of 50 is level. It means equal month-over-month activity. So obviously you can see we've fallen pretty sharply as everything kind of started. We've come back up, and now we're at 40, which is still kind of low, but we've been down below 50 pretty much in the whole second quarter and into the third, coming into the third quarter here. So you can see regionally kind of how it's been broken up. Obviously, the South's done quite a bit better than a lot of other places, just given the fact that we really didn't have, again, some of those long-term shutdowns and impacts that a lot of the other parts of the country had. But certainly the architects and engineers are showing or saying that they're not seeing the production activity that they had seen in the past.
So we have a number of other leading indicators that we're looking at, and all businesses are looking at right now. In the construction industry, the AGC does a great job of tracking economic data. They got a plethora of information on their website. If you don't tap into that currently, we encourage you to do that. The ABC as well does a great job. The first point here is the 4 straight month decline in construction spending at $1.3 trillion. Banks are something that obviously a big primer to the economy and something that we're watching closely. We included another quote here, and this is from Jamie Dimon, who's the CEO of JP Morgan, the biggest bank in the United States. He states, this is not a normal recession. The recessionary part of this you're going to see down the road. So again, to the same points that while we haven't seen it yet, we're probably going to, and it gives good perspective on how banks are thinking about this. PPP loans have taken up the vast majority of the focus and time of banks up to this point, facilitating those, administrating those. They still continue to focus on those closely. The forgiveness application process seems like it's been on hold here currently, and the rules keep changing and are fluid. So they're sitting back and evaluating that, but they have shifted more focus into increasing reserves. Some of the reserves that banks are putting up right now are only akin to what was done during the Great Recession. So again, another indicator of how they're thinking about the long-term impacts of this. And we have seen some tightening in lending. More of that is on a macro basis. Here locally in Georgia, we can continue to see private projects funded. Now, some of those are in markets with very strong dynamics. So Buckhead, Midtown, multifamily developments there. But I'd say for every couple that you see are moving forward, there's still those that are getting shelved as well. Bank lines of credit, we've heard that banks are being pretty consistent about those so far. We have heard of some terms changing on new lines of credit, perhaps shorter renewal periods, so banks can hedge that risk a little bit. Looking at your overall risk management strategy, taking a look at your bank line is a very good thing, depending on what your business plan is. If you can get a little bit of extra cushion, now is probably a good time to do that. And in terms of construction bid activity, bid lists have been getting pretty interesting over the past couple months. We've seen a big uptick in competition. We actually saw a little bit of that happening before COVID even hit. And we felt like that might be an early indicator of some private markets starting to slow just a bit. It's even more pronounced in the current environment. And most of that are on your smaller jobs under $10 million on public work. Public budgets are more strong than the private side by and large right now, at least locally. And Georgia's fiscal year in 2021 budget that was released at mid-year. To sum it up briefly, it's about a 10% broad cut across the board. When I think about the overall impact of COVID, that strikes me as a fairly reasonable cut, especially compared to what some other states have gone through. Georgia also has very strong reserves, which should benefit us in the short term. K through 12 was one sector that was mentioned in some of the write-ups I've seen on the budget. There was projected to be about a $950 million initial cut to K through 12. It's uncertain how much of that will actually go towards construction versus other expenses within K through 12, but that's been a very busy market over the past couple of years. And I would say that would be one to reasonably think there might be a few less schools built in the coming year or two. And then record unemployment, always a very important indicator that we watch. We're hovering about 10% unemployment, which historically is very high, and it remains to be seen when are businesses going to have the confidence to hire, on a broader scale. That's probably going to be a very gradual process.
I think even with that 10% cut, they pulled like $600 million out of the rainy day fund. There was a big number that they pulled out of, their reserve.
Correct. And I would anticipate there would be some bond issuances, going forward to supplement some of that decreased tax revenue. Of course, that's debt that all has to be paid back long term, but should lessen the short term blow. And we're hitting you guys with a lot of quotes today, I know, but this is the last one. But it's a very important one. And I'm going to actually read this one. We need to put less emphasis on the pandemic, which we cannot control, and more emphasis on navigating our businesses through it, which we can control. Dr. Tom Schleifer is a former contractor, for those of you that are not familiar with him, and he's spent the last couple of decades as a professor in construction at Arizona State University. He's also been an advisor and consultant to a lot of companies, mostly contractors. And this is, I think, very sound advice for any company going through uncertain times. External factors, we have very limited control over those to no control. So focusing on how those external factors could impact your business under multiple scenarios will help you manage your business better going forward.
I would just add for this group, please put him in your browser and Google him. He does a lot of blogging on this topic. He just wrote an editorial for ENR in the recent edition, and it's very much on point of the theme of what we're talking about today.
Yep, absolutely, I agree.
So to Dr. Tom's point, when we look back historically at why contractors fail, most of them, all 10 of them actually, are self-inflicted wounds. And so as we look for a potential economic change, I think it's important to look back at what's caused these failures. We actually at Travelers tried to redo this list a couple years ago and found that they really haven't changed. I mean, since the original ENR put out a list, I think back even in the late 70s, early 80s. So, we're seeing it becoming increasingly difficult to build backlog for 2021 and beyond. And as contractors start kind of worrying about that and worrying about where they're going to get some of their projects, they tend to look beyond what their normal areas were. And that's why we wanted to kind of refresh everybody on the top 10 losses and then try to hit on a few that you kind of take care of. I think the first one's probably out of bounds here. I don't think anybody's going to be growing too fast right now. And if you are, I think you would definitely know that you're doing it in the wrong way if you can pick up a bunch of work right now. There's a few though. Geographic expansion, that's the first thing everybody tries to do, is try to spread out a little bit. Some of the other ones is the types of work you pursue. Maybe you've been consistently been a K through 12 builder or federal builder, and now you want to go start building, hospitality or go start building hospitals. And if you don't have that expertise, that can be difficult. Inadequate capitalization. We're going to talk a lot about this and how you can measure your capitalization coming up. Having a good accounting system or a poor accounting system leads to failure. Having a good one, there's been a lot of advancements in this in the industry the last few years, and having one is one thing, actually using it, and Al Clark's here in the room. I think he could attest to that you can have the best system in the world, but if you're not using it, it's kind of useless to you. And then poor cash flow, which is another item we'll kind of touch on and give some maybe some tips and tricks on how to measure that. So one thing we wanted to bring up, and this really goes into the first point, and that's the capitalization, is we review our top 10 losses every year. And we do this on an annual basis. And over the last 10 years, we've seen a significant impact in one catastrophic job. In fact, in 2018 and 2019, 8 of our 10 top losses were because of one bad job. And if we look over the period, 58% of the companies have failed because of one bad job. So we're not talking about a frequency issue. This is a severity issue. And most construction companies, the only backstop they have is their balance sheet. And quite frankly, maybe even their personal balance sheet. So there's a lot of people just lying awake right now thinking they may have their entire life's work at risk. So how can they kind of prepare for that and check and see where they're at from a capital standpoint and make sure they're adequately capitalized, or they're at least identifying the risk that could make a hit to their capitalization.
So this is a list that we actually borrowed from a presentation that the Family Business Institute presented on back in April. For those of you not familiar with the Family Business Institute, they've been around for a number of years, and they specialize in consulting to contractors primarily. And this is a list of critical actions that really all contractors can and should take. The first on the list is leading strong. Everybody has some trepidation about the current environment individually, whatever that might be. Having strong and steady leadership at the top is very important to keep everybody on course within the company. Developing strategies to preserve and build cash. As you've always heard, cash is king. It always will be in running a business, and it's even more so right now. It not only helps you keep your business afloat and helps you take care of problems, but it also helps you to capitalize on opportunities down the line, whether it's hiring new talent or ramping up when new work is available. Stress testing your company. So now's a great time to perform a stress test on your company, meaning taking a look at what the current environment is going to do impacting your revenue and your gross profit margins. How does that impact your cash flow? How does that impact your bottom line? And looking at that under various scenarios, that's going to help you make the best decisions for your company going forward. And then that ties in with evaluating your organization, talent, and structure. If you haven't done so already, taking a close look at your overhead structure, identifying areas where you could make some changes, or maybe the best areas to change. That way, when you get to that point where you feel like that's a necessary decision, you're ready to go and you can act on it quickly. And staying close to your clients and customers, I think that's pretty self-explanatory. Everybody understands the importance of doing that in order to maintain that relationship. Having that level of trust is critical, and that's going to put you ahead of the rest of your competition in terms of future work with that owner. And then evaluating your trade partner networks, meaning subcontractors and suppliers. It's a good idea to understand how your sub and suppliers are looking at the current environment, what their plan is. Think about, are you comfortable with that still? What your contract agreements might be there. But another thing to keep in mind as you go through that process is understanding that their success is also tied to your success. So also acting as a consultant to them and trying to help them through this could prove dividends. And then assessing your financial and market positions. We talked a lot about financials already, but looking at your current debt structure, where you have your investments and securities. Also what's going on with your market. It's really a mixed bag out there versus what markets are producing work and what aren't. The stories in retail and airport hospitality is very different from municipal infrastructure, even some multifamily. And then 8 and 9, we can kind of combine those, developing short and long-term strategies and then being prepared to take action on those. It can be time consuming to develop a business plan, but really where most plans fail is in the implementation process and actually taking action on those. So think about those plans realistically. Think about actually getting to the point where you're putting them into action and when you would actually do that. And I like this slide. This slide demonstrates what we call the 5 pillars of project selection. selecting the right project for your company is absolutely critical. And this builds on what Brian has already talked about from what we see in our data, that so many contractor failures happen from just one bad job. And so especially right now, as you're looking at other opportunities, if you do pivot maybe into a less familiar, territory, really looking at that job and saying, can I make money on this reasonably? And then also doing it in small steps and gradually. I'll go through the pillars just briefly. Team refers to your actual project management team on the job. What client you're working for, what is your experience with that client, the contract terms, the type of work, are you familiar with that type of work, and your project location. This leads to developing some good go, no-go procedures. And it's important to try to stay in your lane as much as possible in terms of what has made you successful in the past. We have found that over decades of underwriting, that as you look at these 5 pillars, as you stretch into one direction and stack those, your risk goes up exponentially for project failure every time you stack on a new element of these pillars.
Yeah, think of this like a building. You could take 2 of these pillars away and it still stand, but if you start taking 3 away, odds are if it's standing, it kind of get worse. So as you kind of think about projects, and especially if so you're going to expand your geographic location. Well, is it an owner Is it a favorable contract? Is it a type of work if you start whittling down some of these pillars and it gets less and less, it likelihood of risk going way up. So that gets into really the heat of what we want to talk about, and that's stress testing. And back to a webinar Family Business Institute did is what and why. So what is a stress test? Is essentially seeing your company's ability to sustain itself if economic conditions change. And I like to think of it as having 3 plans, best case, worst case, and a more probable case. And why should you do that? Well, that way you can see what metrics might be met and to meet each one of your cases and pull whatever triggers you need to pull. So, Dr. Tom talks about, why wait to cut overhead? If you know you're not going to be able to get the revenue, why drag people down the road when you need to cut it later? So being proactive really instead of reactive. And there's really 4 areas to test. It's capitalization. Again, one bad job taking companies down. Your liquidity, your cash position, which we have a tool to show you there. Your backlog quality. Are you putting on new jobs at margins that you were getting with your old backlog? Essentially, can your backlog sustain what your operations have been? And then your market's ability to produce those pipeline of opportunities. I mean, if you're in the hospitality industry right now, your pipeline's probably drying up. So what are you going to do, with that? Or what about your owners? Are your owners able to weather the storm or not? Do you need to shift and find different owners or find a new market? So we want to kind of pivot here to 2 different stress tests that we've kind of created. And one's going to be what happened to the marketplace the last time we had the last 2 recessions, and then one into a tool to measure kind of cash flow. So these, we can certainly, the tool itself, we can get to Doug and make that available. And the other information, I think, has the presentation and can go from there.
So whenever we run a data analysis study, we like to give some background on the data we actually use in our thought process, because that is very critical when considering the data. So this particular stress test took 21 GC accounts. Now it says non-consecutive data. Not every single contractor was the same in every year, just due to some gaps in information reporting. But we wanted to be sure to give you a very long-term view. So that took precedent over the consistent data aspect of it. Again, these are all contractors based in Georgia, all GCs. You'll see the average revenue range when we get into the slide, but the range of contractors on revenue here are 4 million to 330 million. So we do have a pretty broad base. We took out any national contractors that we handle out of this state. You good, Brian? So this is a trending chart for revenue running from 2001 to 2018. And we see 2 recessions represented here. We have the one in the early 2000s surrounding the dot-com bubble, and then we have the Great Recession. And the block periods actually are representing the impact we see to the construction versus the actual recessionary period. So the first recession in the early 2000s ran from approximately 2001 to 2003. And during that period, it's actually misleading because we saw revenue increase over that period of time. But that's because of a strong backlog going into that period and carrying forward. But the pain started to actually be felt after the official recession was over, dropping from 2003 to 2004. And if we look at it from a 2001 to 2005 window, capturing the recession plus 2 years after, we have a revenue increase of a total of 34%. So doesn't sound too bad when you think about the great recessions, and a demonstration of how really recessions all operate a little bit differently and impact the economy and the construction industry a little bit differently. Now, when we look into the Great Recession, which technically ran from 2007 to the middle of 2009, we see almost an immediate impact. It drops off from up there in the low 70 million range to high 40 million range, and it continued to drop even after 2009. So as we look at the impact to revenue on just the recessionary period, we have a drop in revenue of 35%. If we look at it on a 5-year window, capturing 2 to 3 years after the Great Recession, it's a total revenue decline of 17%. So it really has, to Doug's point, the lag impact to construction. So while times are still good, here in Georgia, what does the future hold? And historically, construction has been pretty consistent with lagging at a approximate same time period that the recession lasts. And this one had much longer term impact.
And it looks like about 7 years from peak to peak, or peak to back to break even.
That's right. That's right.
Wow.
And so this slide, same time period, but this shows gross profit as a percent of revenue. And we see that in the first year of the dot-com bubble recession, we actually had an increase in gross profit margins, but it dropped off about 2 points after that, which was where the pain was felt, just slightly after the recessionary period ended. And it never really came back. If you look at it all the way through 18, and to Brian's comment earlier, margins have never really gotten back up to where they were in 2001. So then you look at the Great Recession, we had an even bigger impact on a declining gross profit trend for 3 years, and took another 2 to 3 years for that to get back up to that lower average of 10%. So I think this information can be useful, as while we don't know exactly how this recession is going to play out, it gives you some examples of how to think about this, and really does prove the lag impact. So this is from a separate stress test. It's a very similar sample. These are GCs in Georgia. It's a slightly different sample, but I did want to include this with the presentation with the focus on the green line, which is overhead as a percent of revenue. We've talked a lot about overhead as being an important aspect of your business to consider, especially managing through difficult times. But one thing I wanted to highlight here is you see that overhead has an inverse relationship for the most part, against operating income. And overhead as a percent of revenue spikes up in 2010 when operating income has its sharpest decline. And that's where the trough was on revenue as well. Now, when you look at 2011, revenue remained flat, but overhead as a percent of revenue actually declined about 2 points. So you can read into this that these companies still ultimately made cuts to their revenue, but it was very late, and making overhead cuts are easier said than done. But maybe had some of these contractors been more proactive about making those cuts, it could have saved a tremendous amount of money, and probably would have lowered their risk profile a bit as they were going through the Great Recession.
And kind of going back to the stress test, one thing I want to point out is how we are using this information for our customers. So we've shown our customers if I can get it to work, these last few stress test. And we'll do it where we show them their own information, what happened to them the last 2 recessions. We'll put a peer group together that's a little closer than what we maybe have here to show them what the marketplace did, and then kind of roll it on a going forward basis. So let's use your 2019 information. If you had the revenue impact that we saw in the last couple of recessions, what would that look like? If you had the margin impact that we saw in the last few recessions, where would you be? If you made no cuts today to overhead, what would be the end result? And if you wind up with a big negative from an operating income standpoint, all right, well, this might be something you need to look at. If you start seeing margins go down on a bidding basis or margins go down on a production basis, maybe we need to start making some cuts. If we start to see revenue start slipping, here's what may happen to our company on a going forward. So trying to use some historical information to make forward-looking decisions is how we're using it. So again, that stress test of if we think, and I don't think we're looking at another great recession, my own personal opinion, I'm not an economist, probably looking more like the mild recession. So if we have another mild recession, what happened to my company if I was around then? What happened to my peer group if I was around then? And how might, if I just use my information today or an average of the last 3 years, what might my company look like, in 2020 or 2021, and make adjustments as you kind of see fit as some of those triggers start happening. So just kind of wanted to highlight how we used it. And it's been successful. I will say we started giving this to our customers mid-year last year, and they thought we were crazy. And we probably were, because there was no indicators that there was going to be any sort of slowdown. I'm glad we did it though, because there's a lot of people now looking back at some of that information going, okay, we kind of see where we're at and what might happen here. So another kind of stress test we put out when COVID hit was the idea of a cash flow stress test, right? Cash is king. We've kind of hit on that. And our thought at first was there might be some extreme work stoppages or shortages due to COVID, and what might happen. A lot of people in the industry jumped in to force majeure clauses and everything else. I know Sterling's put on events talking about contract clauses, and those are important. Our kind of thought was that's great, but you can only fight about force majeure if you're there at the end of the job, and if you don't have cash, you're not going to be there. So let's hurry up and do a stress test if we, jobs get shut off or get some significant delays. Thankfully, we haven't seen that, especially here in Georgia. We didn't really see those stoppages or delays, but it does kind of leave the idea there could be some disruption in cash flow and in revenue here if we are earning some sort of economic turndown. And to contractors, cash is a lifeblood. There's usually ill-equipped for any sort of long decrease in cash flow. So trying to take the steps necessary to protect against that. So it's somewhat simple. We came out with this Excel spreadsheet that we used it based off of internal year-end information, because right about COVID hit was when we were getting a lot of CPA financial statements. Most contractors are fiscal year-end, calendar year-ends, and then kind of run through some scenarios of essentially your sources of cash, your outflows of cash, and then you could do some different scenarios based on if my revenue starts falling by 20%, if my margin starts falling, and kind of how that cash flow looks throughout the end of the year. So again, forward-looking indicators. So running scenario one might be a best case, scenario two might be a worst case and a more likely case. Or what if you lost one customer? If your one customer makes up 50% of your revenue and they go out of business, what would happen to your cash flow impact? So again, trying to prepare, and it's a spreadsheet we're happy to share. It's not proprietary or anything to only Travelers customers. There's few instructions we could give with that, but again, trying to predict what might happen if something, rather than just sitting back and being reactive to that.
Yeah, and receivables are a big thing too. That's one neat part of this sheet. That's one neat part of this sheet, receivables, of being able to adjust that. A lot of data suggests that during the Great Recession, it caused receivables to delay on average about 10 days. So that's probably a decent benchmark, particularly with your private owners, to factor that in. And then you can factor in, I know a lot of our customers as well receive PPP loans. So there's a one-off positive cash flow, and this sheet allows you to add that in, or one-time distributions or dispute settlements, et cetera. But like Brian said, we'll be happy to provide more details if anybody's interested.
So a few final thoughts as we close out. Doug mentioned the construction industry lags 12 to 18 months. So we'll see what kind of happens. It's going to be interesting because we're going to be at a time where people are probably desperate for backlog the beginning of 2021, yet they're going to be getting financial statements from a very good 2020. Most people had backlog in 2020. If you were to go back to some of those revenue slides, you saw some choppiness in 17 and 18. And people kind of felt that, and so they really loaded up in 19 for work, which is why 2020 will be good. The the big difference in this recession is going to be the municipal budgets. You know, we mentioned 30 million unemployed. Typically that's been the backstop for contractors, is to go get public work. We'll kind of see what happens. It's not going to be in, you know, anytime soon, because most budgets have already been set for the next fiscal year for most municipalities and states. So that's still kind of left to be seen. But you know, there are some positives here. There's a good opportunity to upgrade your teams. We've seen that from some of our customers. They're able to go get good talent for some less financially stable companies. And so it's a good time to maybe, you know, find a few more A and B players and get rid of some C players. But you need to be proactive and not reactive. Identify the markets that are going to be strong, and really use your data and analytics. There's, again, been great systems brought into construction. Use them. You know, I would stress upon you to use your resources and your advisors, your CPAs, the insurance agents, your surety to get data and make informed decisions. We're not at a point anymore in the construction business where it's the seat of the pants. There's plenty of good data out there. The one thing I do want to mention is I don't want to feel like we left out any of our heavy highway folks in this discussion. A lot of what we've shown is GC trends. A few reasons. One, heavy highways are a little less impacted by outside economic factors. And number two, if we were to look back in Georgia, we would be looking at the last two recessions, which was pre-highway bill, where we got some additional gas tax funding. So it really would be not comparing apples to apples, it'd be apples and oranges. So, you know, that's one reason. If we can certainly get some other trends on, you know, heavy highway and particularly highway contractors working for GDOT, but that is that. So take whatever questions anybody has in the room or anything that came through, Katie, and happy to answer anything.
Haven't seen anything yet.
Okay.
And they're not, they can unmute themselves if they
Oh.
want to speak.
One of the themes, I think, one of the themes that may not have been on its own slide, I think, is just honestly assess where your business is going, where your markets are going. If you're a hotel builder, you're clearly not going to have the volume you've had. We've got some of those in our portfolio. They are making contingency plans to reduce staff costs. There's just no two ways about it. They're going to have less revenue next year. And if you're in some of these markets like hotels, like entertainment venues, like aviation, like some DOT, our DOT is well funded, but there's other adjoining states around the South that are not as well funded, that have already cut way back on their programs. You know, you really need to have, like Brian said, proactive plans for your receivables. I mean, if you have collections that are coming in from some of these stressed industries, retail being an example, honestly assess that. You've got to have plans to deal with these heightened risks. To put your head in the sand is not a strategy. That's what Dr. Schleifer talks a lot about, is being proactive and honestly assessing, you know, the risk that's in your business and the market opportunities that you'll have as we go forward, because there's no question some of those areas that we just mentioned are not going to have as much work for a while. And so you're more than likely, there are some people on the web listening to this that you just simply are going to have to reduce the size of your business, because the ability to replace your backlog is not going to be what we've seen over the last 10 years. It's going to be less. And so that's a hard reality to face, but if you want to have a healthy business on the other side of this, you have to get out in front of that, I think, is probably one of the themes that you know, we would suggest you take back.
Yeah, I think there's some others, you know, COVID related had an impact on production, and being realistic with scheduling with owners and things that can impact liquidity down the road. I mean, contractors are famous for, I built that last building for you in 16 months. I'm going to do it in 15 this time. I mean, they're competitive individuals, and that's why they're successful. So being realistic about what production looks like these days, and making sure you're accounting for that in any general conditions, or maybe even building in some additional if we see the second wave really increase and we do see some shutdowns or slowdowns. I mean, being prepared, it's here now. You know, saying I didn't think about that is probably not a good excuse. especially with owners. They're not going to want to hear that. So one question came through about emailing the cash flow spreadsheet. Yes, we'll get that out with some instructions to Sterling and kind of let them distribute it to the list. So we'll make sure to take care of that. So.
Hey, Doug, this is Frank Spears. How are you?
Are we getting a,
Is that a question?
was there a question coming through on the
Doug,
audio?
this is Frank Spears by cell phone.
Yes,
Can you hear
sir.
me? Hey,
Very slightly.
slightly. Okay, I'm sorry. I can hear y'all great. I just, I don't know whether you can hear me or not. So whatever. But yeah, just the office market, if y'all can talk, we've talked a lot about the hospitality and retail industry, kind of what's going on there, but office market, my opinion, is broken. Is just kind of what the thoughts are on that.
On the office market?
Yeah.
You want to take that? I think the question is, what are we seeing in terms of the office market?
Yeah.
And,
Is it?
I
Yeah.
think by and large, we've seen, those projects continue. We have seen some isolated shutdowns. There was one high profile one, I don't think it's restarted here in town, that was being developed by a big retail developer. And I think that's been put on hold. And, I think in general, the vibe that, we're hearing around the industry is that, you're going to see a lot of sort of shifting strategy there in terms of reconfiguring space. Because I think, at least my observation is, and the new Travelers guys can weigh in, is that, there's some things that are going to be permanently changed on the other side of this. We've gotten very comfortable doing virtual meetings and Zoom calls and so forth. And I think a lot of our clients have as well. And I think that's going to have, frankly, a permanent impact on demand for office space, what that space looks like. I think there's going to be rethinking around densities in office space. So it could be that they're designed to be less dense. There was a trend that we were seeing to more open office environments that may be needing to be rethought given the desire for more spread out environments that we're experiencing right now. Whether that holds or not may have a lot to do with how quickly we get a handle on this disease, but there's certainly other coronaviruses out in the world and other respiratory challenges, SARS and H1N1 and so forth, that have not been too far back in the past that caused a lot of tension. So I'm not so sure that won't be a permanent impact even if we get a vaccine. But those are sort of some of the observations that we've had.
Yeah, I think ground up, anything in construction obviously is going to finish. It's kind of hard to stop an asset being built at this point, but there'll be reconfiguration of office spaces. Things that are there are going to get rebuilt. But I think a lot of what you'll see is a pause to see what's going to happen with this next generation of working. Unless you're somewhere like here locally at the Battery, I imagine that's going to continue to get built out because there's a need to do that for some other things. I mean, the one thing that's in flux is the whole, where are people going to live? I mean, is there going to be this, rural flight that everybody wants to go get out of the city again because they can work from home? Are we going to see people leave other states and come down south where we have better weather and better, more business friendly economics and stuff? So that could end up leading back to a boom in some office space. I'm still amazed to read the Business Journal and see some of these big developments that are in plan. Now, I haven't seen much being broken ground on some of those things. So I think everybody's kind of holding their breath right now. The good news is the banks are in pretty stable situation as opposed to the last downturn. There's still plenty of cash on the sidelines, and they're preparing for some consumer credit crisis coming down the road, and they've put reserves away. So I think you'll see a lot of wait and see in this one.
Any other questions? Either via the messenger or verbally? That's it. Scroll past that, I think.
I think we got hers. The stress test
Okay, gotcha.
or cash flow.
All of that.
I just want to say thanks very much to Brian and Ryan. Hopefully, I think there were some really good nuggets there and hopefully something you could find useful. We'll definitely get the spreadsheet out to everybody. Please be on the lookout for our next program. We've got it scheduled for September 24th. It's going to be on sales tax issues and challenges for contractors, how to accurately comply and prepare for audits on the sales tax front. That's going to be presented by Stephen Bradshaw, Bennett Thrasher. So be on the lookout for that. And thanks very much for your attendance.
Have a great day.